Let's talk markets right now because our next guest says equity is likely to keep jogging in place for the near term. I want to talk about what jogging in place really means. Meera Pandit's here, global market strategist at JPMorgan Asset Management. Is that like being on a treadmill and you're just jogging, not going anywhere? What's happening here?
Do you have the treadmill like this? That makes a huge difference if you're up like 20 or 30%, doesn't it?
Perhaps a little bit of an incline when we think about where we are today, because if we consider the market environment, we are after the inflation spikes and the Fed hikes. We are pre-economy souring, profits souring further. So there's not a lot of upside catalyst at this point when we think about profits only better than feared.
It's not like a HIIT workout at Barry's boot camp. This is just doing nothing.
Or
like
those ellipticals, which move themselves. I watch people do that, and it's like you're doing nothing.
The moving stairs,
those are hard.
Oh, come on. The stairs and the elliptical, if you push yourself, you have to push yourself on the elliptical. That's the problem because it requires you to move it.
And both feet got to be off the ground at the same time for fat people to lose weight. Take my word for it. Sorry.
So 12 months out, what do you think the market looks like, equities-wise?
I think the challenge is right now markets are priced for immaculate disinflation. They are priced for above trend growth, and we have seen 4 quarters in a row of above trend or at trend growth, and tracking for a 5th one when we look at the Atlanta Fed's GDP tracker. But if we think about the summertime, having a nice ripe peach, that peach can go from ripe to rotten pretty quickly. And so I do think we want to be cognizant that
got a lot of anecdotes, I just have to say.
That's dangerous.
And they're all healthy, too.
When you come on the show with anecdotes.
Peaches, we haven't got to the carbs yet.
No.
So,
empty calories.
So help us. Are you suggesting that people should be in cash right now?
No, because ultimately people who have been in cash and came into the year thinking, I'll take that 5% income any day. I don't want to deal with what's going to happen in the bond or stock market. Have experienced a huge opportunity cost in the fact that we've seen a big run up in markets. What I'd simply suggest is when we think about investing, we want to stay invested, but we also want to get back to the basics, because when the macro environment is somewhat inconclusive, as it has been in the last 18 months, when we go from every scenario of every type of landing, we want to think about price and we want to think about fundamentals. And ultimately with earnings, let's look for the areas where you're actually seeing a bit more upside there. And earnings have gone through somewhat of a rolling recession where you're still seeing areas like energy and materials have some downward revisions, and yet areas like industrials, communication services, consumer discretionary seeing some upward revisions. Now, I'll admit a lot of areas in the U.S. equity market are a bit expensive, so we want to be a bit mindful of price. But it is about that relative valuation and where we can actually see.
But what do you think about the overall market, which is to say you look at the Home Depot news, and I think the market's selling off in part on that, in part on the bank news, in part on the China news.
The China overnight. I mean, it just seems like a little bit of an unstable environment. And then you have yields ratcheting higher. Do you think that reflects a positive economic scenario, or is that a challenge for equity valuation?
When we think about the rise in yields that we've seen more recently, there is the fundamental story, there's the technical story as well. On the fundamental side, I think it's more about elevated growth. I mean, what we saw was a big pop in yields when that second quarter GDP number came out. And if you track yields, especially the 10-year yield against the Citi Surprise Index for economic releases, that has also continued to rise in tandem. So I think it's really about growth. Yes, there's an inflation break-even story here a little bit, but I think the reality is consumer expectations for inflation have continued to come down and are pretty well anchored when you look at the Fed's data, when you look at the University of Michigan's data. And then on the technical side, the supply piece is an issue there, too, when we're seeing it's not just about the T-bills. It's about the 10-year. It's about the 30-year maturities as well. So that has also pushed yields a little bit higher. But I do think that growth is a big piece of this. So if we continue to see above-trend growth, which I don't think will be the case for the next 12 months, and probably not even for the next 6 months, then yields can stay high. But I think the reality is, even if we don't see a recession, you're going to start to see those come down a little bit.
So therefore, you may want to actually own a little bit on the longer end of the curve. Yeah.
Unfortunately, what we've seen is a delay in the reset of the bond market, but I think that also extends the window of opportunity when we think about entry points in bonds. And again, when the equity market is looking a little bit expensive and priced for perfection, there are cheaper places to go for investors.